everyone, and welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of November the 28th, 2016. Now, to get started this week, we're going to begin where we always do with that all-important US dollar index. Now, the US dollar index is having quite an effect on a number of different things. It's affecting oil, it's affecting gold, but it's also having a direct intermarket correlation to the global equity market, specifically the S&P 500. So basically, as the S&P 500 breaks above 2200, the dollar index breaks above to its new high levels also. So what we want to look at here, guys, and understand our critical levels with the dollar index. Last week I had talked specifically about a corrective move in the dollar. We actually did get that against a number of different currencies, but we did not get that against the yen, the Swiss franc, or the euro currency. Now, the British pound was pretty stable. The British pound showed some decent gains for the week, but more or less sideways. The real winners were the Aussie dollar and the New Zealand dollar. They seem to come out of that pretty good against the overall dollar strength. Now, our key vantage point level comes in this week. Our 18-day predicted moving average at 100.20. We can see this level right here. Now, what I've talked about, again, an early warning sign here is the medium-term predicted difference crossing over the long-term predicted difference, but our long-term predicted difference, we can see that it's turning back to the downside. This is a problem for further dollar gains early to midweek. Now, we have the non-farm payroll next week. That is going to have a direct outcome on what the Fed is going to do in December. I think the Fed fund futures are currently pricing in I believe 100% chance of a rate hike in December. So a lot of this price action in the dollar is being baked in now. So we want to be careful, very careful of this. Now, our predicted MACD, we can see that it looks like it's forming a top. Our predicted RSI, once again here, guys, classic head and shoulders pattern here inside the RSI. And again, we can see that it is pointing downwards. And I'm certainly not suggesting that the strength of the dollar trend is over with. I'm suggesting that again this week that a very strong basically corrective move lower is very reasonable based on a number of these indicators. So we have to be very mindful of that going into next week's trade. Now, when we look at the S&P 500, once again here, guys, the S&P 500 has been 100% correlated to the S&P 500. So as the S&P 500 goes up, the dollar index goes up. So if we look at this particular signal here from VantagePoint, essentially when the S&P actually started to really rally, we can see the exact same thing in the US dollar index at the exact same time. So you can see I left the circle on the screen and I'm simply changing between the two charts, and it is exactly at that time that money went into the US equities and the money went into the US dollar. That's an indisputable fact here, guys. So when one falls, chances are the other one will fall also. So when we look at the S&P 500 for next week, 2170 is our key level here, but we've broken through this congested area of resistance, which would suggest further gains ahead for the S&P 500. Now, our DAX 30 is in a very stiff area of resistance here that it actually is not faring very well compared to the S&P 500. The Nikkei, once again here, very similar. So if we take that circle of that breakout point right around the election here, and what I'm going to do just for fun is go back and once again show you the circle on the screen between the S&P 500 and basically all of the global equity markets moved up at the exact same time. Now, does the same thing apply to oil? We can see that the chart falls out of the circle. So a kind of a cool way of doing it here to illustrate a point. Now again, in order for the dollar to continue to move higher, it would appear that these global equity markets also need to move higher. That's what we can see on the screen. That's what basically VantagePoint has forecasted since that crushing Trump victory of Hillary Clinton absolutely destroyed her in the election. So when I look at oil going into next week, oil is going to be a big week for oil next week also. We've got the OPEC meeting. This could decide the fate, the next big move in oil here. Now, that's going to have a direct intermarket correlation to the British pound and the Canadian dollar, and it looks right now that it could be positive for oil next week. It could be. A lot of that's going to depend on Iran, what they're going to do, so we'll have to wait and see, but be careful around this one, guys. This OPEC meeting is a big one, so our key level for next week, 46.85. This is a pretty significant level. We've slipped below it at 46.06. We're also pushing below this trend line that I've drawn in here. Our indicators from VantagePoint are suggesting oil is going to go lower, but again, be careful around this OPEC meeting next week until we see what comes out of that, okay? Now, when we look at gold going into next week, I've had to go all the way back to almost a year ago to bring in my supply and demand areas, more importantly, my demand area. Now, that level is broken here. I think that you can see that really gold had a big problem. Right after the Brexit, gold got a little bit of a Trump boost here, I'll call that right here, once the shock set in that this guy was actually going to be president of the United States. You can see that it went flying higher, but then immediately collapsed all the way down to where we are here, which is what I believe to be the true price. Brexit here, you can see that once we broke below the Brexit low point, gold continued to move lower, and it really right now, it's going to be very difficult for gold to make any substantial gains while we're under 1228.88, the key VantagePoint 18-day predicted moving average. We're going into a potential rate hike. The nail in the coffin for gold very well could be the non-farm payroll number on Friday. If we get a solid jobs number, forget about gold, guys. It doesn't stand a chance. It is going to go much lower, probably down into the 1100 range. 1080, 1060 is what I've discussed with my own direct clients. I believe that that's where we're going after the break of the Brexit bar. Gold did not get the boost that everybody thought it would based on Trump being elected, so that's strike two. Strike three is the trend line break and potentially a very strong non-farm payroll number on Friday. So selling gold into rallies up into this 1228, guys, that's a decent play to start the week. Now, with that brings its high correlation the gold has to the euro currency. As long as gold is moving lower, chances are the euro is going to be moving lower. Now, our critical level, our VantagePoint level now comes in at 107.23. I could absolutely see a retracement to this area. I've been waiting for it. We didn't get it last week in that holiday short week, but we very well could get it this week. But any move higher right now is selling into rallies is definitely a decent play, but buying down here on this bottom is reasonable as long as your stop is fairly tight here, guys. So if you're buying, which what I've advised some of my own direct clients, keep your stops below 104.40 to play this corrective move back to 107. But I would be cutting any long trades. I would be very nervous holding anywhere near this 107.23 area. Now we tried to push up here this week, but you can see how the market is simply hugging the VantagePoint 8-day predicted moving average. Multiple tests of this area here. Basically, we've tested that 4 times this week. That number here is currently at the 106.14 area. So that is containing any rally. If we break through this 106.14, 106.30 area, close above that area, then and only then could we hit the key VantagePoint level of 107.23. Let me just clear that off so everybody can see it. This is our critical level of 107.23. If we break through that, then we'll see a much bigger corrective move, probably to 109. The only way we're getting to 109 here, guys, is if we get some comment from the Fed, or we get a very weak a surprise weak non-farm payroll number. I don't really see that in the cards right now, but anything's possible. Now, of course, US Swiss franc is nothing more than a Euro US trade, but even as Euro US started moving higher this week, US Swiss franc also moved higher too. Now, the key thing to understand with US Swiss franc, it is 100% correlated to the dollar index. So that means it's indirectly 100%, 90% correlated to the S&P 500, the Nikkei, the DAX, that intermarket correlation that I've shown everybody over these many months and I've talked about here today. So when we look at this right now, we've got a potential top up here in the 102, a short-term top. I believe that area will give way, but only after the non-farm payroll number. I think that we're going to hold below this area. I'm not expecting a big move to the upside next week unless, once again, somebody leaks the non-farm payroll numbers. So once again, with Trump coming into power, is information going to be leaked? I don't know. Has information been leaked in the past around the non-farm payroll number? That's difficult to say, but it certainly looks like there has been problems with somebody keeping this information contained. So for now, I think what we're looking at here is a corrective move. The corrective move is back to the parity level. The 18-day predicted moving average from VantagePoint coming at 1.0006. This area here, I believe, will continue to hold, and we're going to probably try and retrace to this area prior to the non-farm payroll number. Then we'll regain and make our big push back towards that 104 area that I've discussed again with my own direct clients, that's our year-end target is up in that 104 area. Now, as we come into the British pound for next week, we potentially, guys, have some opportunity both on the long and short side of this one. Now, we have been hugging this critical VantagePoint 18-day predicted moving average almost every day this past week at the 124 area. So right now, we are just barely closing above this trend line that I've identified here. Our neural index is up, but our predicted short, medium, and long-term differences remain locked dead sideways. No buy signal, no sell signal, just dead flat. Now, excuse me, we're holding just below the zero line on the predicted MACD. Our predicted RSI still carries a mild bullish tone to it at 56.3. But if we can get that predicted RSI moving above 60, we're going to see momentum build, okay? Now, the predicted RSI from VantagePoint certainly has not been above 60 very much in the last 3 months. And in fact, it's only been above that area on 2 occasions, and realistically only for 2 or 3 days at a time. And so, but what I will point out here is that we're bouncing off that all-important 40 line. Now, anybody who knows me has been to some of the seminars or what I've discussed here on Trader Planet over the years is using that 60-40 split. I'm using it to gauge momentum here. So below 40, it's very bearish. Above 60, it's very bullish, and we have momentum. So the fact that we couldn't push below 40 here suggests that we could have some strength here. Now, if oil prices shoot up, the British pound and the Canadian dollar will strengthen here. So that's something you want to keep in mind with this OPEC meeting. Keep a very, very close eye on oil prices next week here, guys, because it could lead to 2 trades, a long on Great Britain, US, and a short on US, Canada. My optimism on that, however, remains heavily guarded at this time. But the key VantagePoint level, 124.23, we're closing 124.73. This is basically exactly where we were a week ago here, guys, and you can see it in the chart, very sideways action. But we do have a triple EMA cross. Our 3-day has crossed over our 8-day and our 18-day predicted moving average. So there is a very slight, albeit slight, bullish bias to this particular pair. Now, as we come into the dollar-yen for next week, once again, I warned everybody, just because this thing is grossly overbought, it doesn't mean it can't go higher. The dollar-yen is notorious for taking out stops. So they've really run this thing up. Our key VantagePoint level now, 109.17. We are at 113.13 here. Now, you'll remember that I talked last week saying 2 weeks ago that if we break the 107.50 level that you are to buy immediately and get on the train because it's leaving the station. That is exactly what happened here, guys. And the long trade from 107.50, easiest trade you'll ever have. We then had additional staggered resistance up here around the 111, and I again warned that if we break through this, we're probably going to move towards 114. So we're at the 114 level now. The question is, can we go higher? When we look at this on a year-over-year basis, you can see right now there is not a lot of resistance above 114.80. So if we break through 114.80, that is probably going to take us back to this 120 or potentially above, but that is going to take a significant upward move on the equity markets to support that trade. The intermarket correlation will trump every other indicator we have here, guys. So the dollar strength, if it's going to continue, then we need the support of those global equity markets, specifically the Nikkei and the S&P 500. So right now, we are stalling just under the 115 level. We'll keep an eye on this area very, very closely, but for now, a very slight downward bias based around a corrective move. Not necessarily a trend change here, guys, but a corrective move. Now, once again, when we look at our medium-term predicted difference crossing over our long-term predicted difference, it's warning us. It's giving us a multiple-day warning that we've got a bit of a potential problem here with this long trade. Now, when we drag this over and we look at our predicted RSI, we're at 91.6. I can't remember any time in the last year where we've been at 91.6 on the VantagePoint predicted RSI. So there is a slight bias. And that area too, that upper level that I talked about, is not for 114.80, it's 113.90, right around this 114 area. So we want to watch this area very, very closely. Can we break through 114, stay above 114 for several days, close above that? We are then likely going up to the 120 area. And we could move up to the 120 area very, very quickly. Now, I believe that the dollar yen has moved up some 6% since the Trump election. That is unlike currencies to do that. That's all I can say. So there's a very, very slight bias. A short trade is reasonable, but you would keep your stop very, very tight just above 115. If we get above 115, guys, we are likely going to run up to 120 very quickly. But our indicators are warning us that there is not a lot of momentum up here, so keep that in mind. Now, as we move into our final three currencies, our commodity currencies, and then what I'm going to do is just do a little quick thing for you guys on the dollar index so you can see the intermarket correlations that I'm talking about that you should know and you should understand. Now, when we look at these three commodity currencies, they're virtually very, very similar, the three of them. When we look at the US CAD for next week, 134.43, but this is going to be affected by the OPEC meeting 100%. So if the meeting goes to par, the Canadian dollar could actually strengthen a bit here. But if they refuse to cut production, we get a lot more demand into the market, a lot more supply, I should say, into the market with such little demand. Oil prices are going to plummet, and the U.S. CAD is going to move towards that 138 area very quickly. On the flip side of that, OPEC decides to cut, we let some of the supply gut move itself out, then we could see a break back into the 134 area. But the key VantagePoint level, 134.43, that's the critical level. Our predicted differences are mixed. Our predicted MACD is saying lower. Predicted RSI, 60.9. So you can see at 60.9, we're still on the bullish side of this. And as I've discussed with my own direct clients, my year-end target for this remains at the 138.50 level. So our supply and demand areas are well identified with the trend lines that I've drawn in for everybody. 135.50 on the downside, and about 134 on the 135.50 on the upside, and about 134.10 on the downside. So we're forming a very tight wedge here, much like on Great Britain, US. So be careful of a potential reversal to the downside. Now, with our final remaining two pairs, Aussie US and New Zealand US, that I'm going to break down some intermarket correlations for everybody so they get a good understanding of what to look for next week going into the non-farm payroll, is, of course, the Aussie US last week I had discussed, basically buying off the Brexit low point. I said this is very reasonable. If we get down to the 73 level, that buy it and keep your stop fairly tight, about 40-50 pips. That was a great trade. That was actually my easiest trade for the entire week last week, because I don't really care what happens. I'm buying off 73. I've got a 50 pip stop loss, and it's a corrective move to the upside back to this key VantagePoint level at 74.82. So I'm just going to clear that for a minute just so everybody can see it. So the Brexit low point continues to hold here on Aussie US and New Zealand US. It didn't hold on the CAD. The CAD broke through to the upside. So when we look at this, the corrective move is to 74.82. Now we could fail miserably at that level on a strong non-farm payroll number, but the Aussie currency is a high yielder here, guys. It does not follow the euro. It does not follow the British pound, and it certainly doesn't follow the Great Britain. So it is its own currency. Aussie US, New Zealand US, that's what at times makes them very difficult to trade, to be perfectly blunt. So when we look at this right now, 74.82, if we break through this area, then we're going to probably come back up into the 76.50 area, the Brexit high point, and then we could break to the upside. But a strong non-farm payroll, US dollar buying right across the board towards the end of next week. Shorts are still favored here, but the indicators from VantagePoint point. They still look corrective in nature. They don't look like they're in the phase of an actual trend reversal. Same with New Zealand US here, guys. We're just simply buying off of this Brexit low point until it breaks. Once it breaks, then we could see a big move to the downside. But on both Aussie US and New Zealand US, you can see that they are both bouncing off the exact same level off of that Brexit bar. So the Brexit range is the only range that matters here, guys. Fibonacci, Elliott wave, Gann theory, this moving average, that moving average, stochastic, all these indicators, just throw them out the window. They don't matter. Okay, when we look at this, this is what's been containing the market, is how the Aussie, the New Zealand, and some of the other currencies responded to Brexit. Not to Trump, but to Brexit. Still a big player here. So when we look at this, the Aussie and the New Zealand still look pretty, they still look like they've got further upside before we start to short it again. Longs are definitely on the table there. So what I want to do here guys, is just, to discuss some of the insight of how intermarkets really work and how they're correlated to the US dollar. So we're going to take a look at intermarket US dollar correlations to help us going into trading next week. The non-farm payroll, it's a wild card, absolutely. But what we want to make sure is that we understand what the current real-time intermarket correlations are. So when I look at this, and again, I do this with my own direct clients, I bring them in here so they can see this. This is an indisputable intermarket correlation. So when people are looking at, wave 1, wave 2, or they're looking at Fibonacci 61.8 of this or that, it just throw it out the window, guys. The fact of the matter is, as the S&P 500 goes up, the dollar index goes up. That's what's happening here. So until this breaks down, this is absolutely into the current trading environment. That's what's happening. So you can see as the S&P 500 went down right here, so did the dollar index. That is an indisputable correlation. The DAX 30, believe it or not, the European equity markets, we're seeing the exact same setup. The Nikkei, identical. So if the Nikkei starts selling off, then that tells us ahead of time that the dollar index is likely to come under pressure. I hear a lot of pundits, a lot of analysts talking about, this level, that level, but I don't hear a lot of talk about intermarket correlations when they're the driving factor of the markets. So when I look at this, even the CAC 40 here, you can see that the CAC 40 goes down, well, the dollar index goes down. If the CAC 40 goes up, the dollar index goes up. Now, oil has had a very interesting correlation. It's been both correlated with and against the dollar. Predominantly oil up, dollar down. Well, that isn't the case. That hasn't, particularly over the last 2 or 3 months. The big rally in oil was met with a big rally in the dollar index. When oil sold off right here, you can see shortly after that, well, so did the dollar index. When the dollar index recovered, well, lo and behold, guys, so did oil. So don't think that because one goes up, the other one has to go down. So this potential top if this is a top in oil right here, that again could cause problems for the dollar index. So regardless what you hear, these are things that you need to watch, that this is the current intermarket correlation. When we look at, specifically gold, that correlation is still fully in place. Gold down, dollar up. So if the dollar begins to fail a bit, gold could probably have a corrective move, but I don't see a big play there. So these are just some of the main intermarket correlations, how the dollar basically correlates to the global equity markets and the global commodity markets. And that is something that you really need to watch in not just in your Forex trading, but in your stock trading and your commodity trading.